Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome again to the channel. This is the Greedy Trader channel. So for those of you guys who are new, this is where we talk about all things market profile. Yes guys, for those of you who are consistent watchers of the channel, then this is just another video. Now, if you don't know what market profile is, it's perfectly fine. 90% of traders don't know what it is. But this is primarily what us as professional traders have used through our journey as traders. Now, for most people, this is something they would have never seen before. One of the problems which limits accessibility to market profile is the fact that it is not available on many platforms that traders use. So even if you think about MetaTrader, which is quite popular, or everybody trading Forex or indices tends to use MetaTrader, right? Because in Europe it's the dominant platform for trading CFDs, right? And all the brokers offer high leverage, so it's very accessible and it's cheap, right? Whilst you'd find that professionals, they won't use MetaTrader a lot because even though it's cheap, it doesn't have sufficient enough technology for the kind of trading that institutions do. And by institutions, I mean like hedge funds, for example, because banks obviously don't need any of that stuff, you know, beyond their Bloomberg terminals and their own sort of proprietary trading systems. They're probably not going to need, some, third-party platforms like, say for example, Sierra Charts or something like that. But if you are a retail trader and you are receiving liquidity from someone, then you would need the best technology, right? And obviously part of that is having market profile. Now, of course, early platforms like CQG, which are very expensive, it's a couple $100 a month, they have market profile inbuilt. Sierra Charts charges you extra for it, and also the platform itself costs money. While it's not as expensive as CQG, it does carry a cost. And when we think about NinjaTrader, which is also very popular with futures traders in the retail space, they're third-party providers, I believe, that offer it in. I don't know if Ninja offers it at the moment, but again, third-party people offer it there. And then you have other platforms that are much more little known, but maybe popular with the institutional space, like WindowTrader, for example, which some of the older people in the space would use just because it was quite the thing in their day, right? So it's kind of how I feel about Sierra Charts, considering that it's not a new platform. It's been around for ages. But for me, that was the go-to, right? Outside of that, I would say CQG, but like I said, most of this stuff is not accessible to the average retail trader because there's a cost to play. And a lot of people don't appreciate that in order to get good technology and to play efficiently, there needs to be a cost. Now, what you're looking at is market profile on my screen, which I paid for to get this developed, right? It was very expensive. And what's weird is sometimes people come and say, can I get, this for free? And, I gave it up for free for quite some time. But with that came also me having to maintain an infrastructure to supply all these people who don't even know me or even care. Realistically, some of them not even using it properly, supply them API so they could, integrate it in what they're doing, right? So again, it didn't make any sense for me. So now it's more or less, it's proprietary. People who work with me, and obviously because they're going to need it, I will provide it for them. But for the most part, I can show you all the cool stuff that you can do with it, but again, if you want to get it, there are multiple platforms that offer it, but it's going to cost you. With me, the only way to get it for free is if, you know, me and you are working together. If we're not, then it is what it is, right? So again, I just kind of ran into that there because I felt it was really important to note that in order to get ahead in this business, there's a cost to having good technology. So today I wanted to talk about largely why market profile traders are ahead of the pack. Right? Why are so many people, even in movies about trading and so on, why you see market profile pop up everywhere? Why are you listening to veteran traders like myself, like others? We're talking 15-20 year guys all looking at market profile. Why are you tuning on to your best famous podcasts and hearing some of your top traders you like listening to all talking about market profile? Well, the reason that is the case is because it's the first way that we've had to visualize the market in a way where we can see where the order flow is, where it's settling, without using something like, say for example, a dome, right? So where we can have a quick visual representation of where traders are too long or too short, as I like to say. Market profile is the only thing that can do that. And also, if you're a programmer, for example, and you wanted to program a strategy, you would need some statistical benchmarks. And again, market profile will give you an easier point of view in order for you to develop a system that you could put to work. Market profile gives you the ability to segment. Most people have a very linear viewpoint of the market, right? And they're always looking for levels all the time, and it's so linear, in my opinion. Whilst with market profile, you have a more diverse look, right? So it's more dynamic, right? So if you're trying to position into a trade, you can do that more dynamically regardless of your time horizon. That's because you can segment the market into auctions, and you can segment it into different profiles regardless of your time horizon. So in other words, you can see the entire market regardless of the time frame at one glance. So you could be looking at a weekly trend or weekly sort of price development, and at the same time you're looking at an intraday price development within that. Like, can't do it with anything else, right? So market profile gives an unusual edge in the simplest of ways. Most people feel like an edge means you've got to spend a ton of money to get that, but really what you need is to be able to visualize data. A lot of the bigger firms have gone down the route of passing through like tons and tons of data, right? And what that does is it gives them a data edge, right? So they can glean a lot of data, and they pay for a lot of historical data, and then they can come to these very intelligent conclusions using machine learning or some other kind of technological approach. While as a retail trader, you got to be fair to yourself, right? You're not going to have access to that. I mean, if you didn't study computer engineering and you don't have an idea about how to implement machine learning within a trading framework, and most importantly, if you don't have access to the data, I mean, if you try and buy historical data, you would understand how expensive it is, right? Most of you have never tried it. You look at your MT4 platforms and they give you data maybe going back 4 or 5 years, and you think, well, that's great data. But what they're not able to give you is tick by tick data for the next 4 to 5 years. Well, the wealthiest funds in the world, they can afford to buy this kind of information. So they're going to have a data edge, right? So they're going to be able to tell you, you know, to the nanosecond, what happened at a specific given point of time, right? Or based on a specific action. They can see other algorithms, which means that they can see what other traders are doing within the nanosecond, right? So all of these are kind of, in a way, they're information edges, right? So maybe as a retail trader, you're not going to have that. So what does that mean? That you can't trade? Of course you can trade, right? Does it mean that you're not going to make money? Of course you can make money. That's not the point. So one of the things I wanted to talk to today about the benefit of having market profile as that substitute to all that really cool technology that you can't have, was to kind of look at how do we approach the market as market profile professionals, right? So you use market profile, that's your go-to, that's how you synthesize data, that's how you decide on how you get in and out of a trade. There are a couple of things that we think about as traders. The first is frame of reference, right? So we're talking about market profile here. My frame of reference is a statistical one, right? So by looking at market profile, I'm giving myself a frame of reference, and every trader should do this. They should create a frame of reference. So what is your reference frame that is allowing you to visualize the market, right, and see what it is, like the demand and supply picture, really get a grip on it. What is your frame of reference? A lot of traders, they don't know that. In fact, that's where a lot of traders get stuck, right? It's just bouncing about frames of reference, right? And if you have multiple frames of reference, you're going to arrive at multiple conclusions. So you need to have a constant frame of reference that you don't really depart from. Like, you can overlay that frame of reference with different ideas if you like, but you have to have a constant, I like to say. So that's your main frame of reference, and you need to trust it beyond else. So that means in choosing your frame of reference, you're going to need something that is going to give you a complete holistic picture of what's going on in the market. So there's not really much left. So if you overlay something on it, what you're trying to understand is, okay, how valid is this idea right now based on this additional information, right? So anything else you get is just additional information that is going to supplement your main frame of reference. The second thing that you'd want to be able to do is understand what's your execution model. Now, this is going to be different from your frame of reference. That frame of reference tells you, okay, well, like, okay, this is the profile and this is what it does. This is what it tells me from a general point of view, right? So this is not special information, right? It's just basic, right? General information I want to know. However, within this framework, how am I going to execute, right? What point do I buy and sell, right? And how can I make that a constant situation, right, where I know exactly where to buy and sell? Now, of course, most people, they can't do that. Like, most people can't put that together because, again, that's a different thing from your frame of reference. What a lot of people want to do is they want to look at, say, a candlestick chart, draw a line and say, if it breaks here, I'm going to go short. Okay, great. So your frame of reference is candlesticks. You want to go short when you break a trend line. Okay, so that's generally an execution model. But again, your frame of reference, is it giving you adequate information? I will argue that a candlestick doesn't, so that frame of reference is not a great one. Secondly, you've chosen an execution model, which is a trend line break. Okay, so how do you validate that trend line break? Well, you know, it's a trend lines break all the time. It's highly subjective. So how do you validate any of this? There's nothing there to do. So your execution model is more than likely lacking if it's not robust enough that it's a repeatable event. It's no good if you drew a trend line, say you did an ascending triangle or some of the other patterns that people look for, and that pattern occurs, say, once a year, right? Well, then you have a decision to make. You'd have to risk a significant part of your portfolio to take advantage of that one opportunity. For some people, this is an idea too, right? Some traders would want to do this. But then if you think about the whole idea of trading, it's about law of large numbers. So you want to be able to trade quite often, but you want to be able to make smaller trades. It's why high frequency traders are quite popular. Well, I say popular, but high frequency trading is popular in terms of the mindset of the trader, is because these machines can make thousands and thousands of trades within minutes, in some cases milliseconds or nanoseconds, for example. So this gives them an incredible edge of speed, right? So that they can do things that a human can't do from an execution standpoint, right? So again, as traders, we need to think about the execution model, and we also want to think about how the opportunity that we're seeing, I mean, is it a repeatable situation? Is it something that you can grind down into some kind of edge? If you can't, then you have to go back to the drawing board. Some people think the learning curve with trading is just doing a lot of screen time consistently, and then hoping that you can make an observation that is good enough that you can turn into an execution model. But no, you have to be able to look back and test things, and, you know, make sure that it's a repeatable situation. Is there enough of this event? Even, you know, because again, if there's not enough, you'd have a decision to make. is that event ever going to occur again? For example, should I put more capital at it when it does occur? And if you don't have enough data on its occurrence because it's so rare, then it gets harder and harder to validate. So you're going to have some testing issues, right? So even if you wanted to back test, forward test, whatever your idea or your thesis is around testing, you're going to struggle, right? So that's the first thing, right? So execution model is important, right? And 3 is your numbers. One of the cool things about market profile is you can see where all the risk points are, right? You can see where all the stops are 100% gone, right? You can see where you are wrong, right? If something happens, you are wrong, and you can see that, right? So let's take an example at the bottom of this market. So on the close of this market, we had a lot of bids, right? So let's use this as an example. We had a bit of a bid stack, right? And we can clearly see that we got a value high here and the market closed above the bid stack. So immediately you'd have to assume that the stops are going to sit just below the bid stack. So the market trades under the bid stack, it's going to draw in a lot of stops. So even if there's not a lot of follow-up shorts, right, which algorithms will immediately take advantage of that, but let's say no one was selling aggressively, it was just the stops that were being cleared out. Well, then either way you're going to get a cascade. So you can, in other words, you can see your risk point, right? So let's say you were on the other side of that trade and you were trying to go long, for example, you would already have a very good idea where you would allocate risk, because anything lower is almost guaranteed that it's going to get you stopped out, but just for a bigger amount. So it's irrelevant whether that stop was tighter or it was further out, you're not going to get saved, unless of course it was ridiculously further out, in which case you've got an open book, you probably have a ton of capital as a retail trader to play with, or maybe your position sizing is pretty damn good where you can afford to have an open book where you really don't care. It's like, well, you know, I've got 20 million, I'm trading, I don't know, let's say you're trading currency, I've got 20 million, I'm trading a standard lot. So I don't really care if the market is against me for 1,000 ticks, right? You know, 1,000 ticks, $10 a tick. Well, that's nothing, right? Relative to a $20 million position, which is the case for a lot of funds. If you've worked institutionally, you realize that that open book policy is quite common. I believe it was Bruce Kovner who says that, look, if you have unlimited amount of capital, then it is what it is, right? You're never going to lose in the markets. That's his synopsis, right? And he's one of the biggest traders out there. You know, traded currencies, pretty much everything, but I think he was predominantly a currency trader, right? So when you put this in a perspective, you start to realize that it's not all things are equal. But again, as a trader that wants to manage risk, and because maybe you don't have that kind of capital, or you manage a smaller fund, like myself, I manage a smaller fund. I'm not a billionaire or anything like that. But on the same token, I like to think I'm a pretty decent trader. I've got a huge professional background, but I'm not managing $1 billion. So as a consequence, I'm not going to have that open book. I need to be able to make sure my return stream delivers. And that means that I need to be conscious of risk. I need to manage risk, and I need to be particular. It doesn't matter what table I'm sitting at or how I'm playing, I need to manage risk. So again, numbers is important, right? You need a system that can show you potentially where your risk is going to lie, right? You know, how am I attacking this market? And I need to be able to see those pain points, and I need to be able to see them really, really quickly. So when they break down, I know to get out, and I'm not even debating it. I recall that everyone, I believe it was this very, where are we today? I think it was about a couple of days ago anyway. Everyone was talking about the $1.6 billion notional position that Michael Burry took out. Now, most people don't understand that actually that, you know, there's a 45-day lag on the reporting for one, and secondly, that could be part of a hedge, or it could be part of a more complex trade, right? So that means nothing. In fact, when you take that notional value, maybe, I mean, Burry maybe didn't spend anything more than, maybe 700 grand on the overall position, regardless of the notional value. So that might not necessarily be a short on the stock market. It might be a hedge where if it doesn't work out, he might be out of pocket for 700 grand, maybe 800 grand, even $1 million. Who knows, right? He might be out of pocket for that. But on the same token, he's probably got another trade which is going to capitalize on whatever the upside is, right? So sometimes you got to take all this stuff at its face value. But Twitter literally lit up with Michael Burry, Wall Street Journal, It's like, what the? I couldn't help but think, well, this is going to create panic. A lot of traders are going to try and sell out of their positions. The market's going to go down, but very quickly it's going to get bought up again, right? And then it's going to start to go higher, and people are going to lose a lot of money, right? Now, if you're looking at the S&P, towards the US Open, and that was on Friday into today, which is the pre-market, right? The market's considerably up, and I can't help but think how many people are going to be trapped now in the short position, because most of those people already got that information towards the back end of Thursday and Friday. If they had a little downside, it was mainly in the pre-market session, so the after hours in the case of the futures market, right? Those guys would have benefited. But then by the time the market reopened, everyone's back to flat or break even, and now they're stuck. Right, so if you're in a short, you're stuck, because now you're thinking, God damn, right? And you'll be surprised the amount of people who are supposed to have professional experience that were retweeting this information consistently, right? And you have to think to yourself, well, if you're following any of these guys and you're seeing them do this, then you shouldn't be following them. Because again, not only are they misleading you, the fact that they can't interpret the situation accurately it shows you that they're not really professionals. They're not really good at what they do, and despite their huge following, they've probably managed to mislead all of their followers into thinking that they're these special people, but they're not, because they can't interpret a simple situation that actually it doesn't warrant the media attention it's getting, basically, right? Whatever the reason behind Michael Burry's tweet, I can't know. I wouldn't even attempt to know, but the fact that people are running around with it like it's gospel information that I personally believe is about to cost people a ton of money when we finally find that bottom for the S&P, it's going to be crazy, right? And and again, it will just be a lesson learned that you need to be able to interpret the information properly. Anyway, guys, I think it was important to kind of break down these 3 points here. That frame of reference, execution model, and numbers are really important when you're thinking about trading. And around all the questions I've got, I hope this is going to be a helpful addition to that. And of course, why you should be using Market Profile in your trading if you're not already doing that. And of course, I've got a free Discord server, link in the description below, and check it out. You'll learn a lot of stuff there. It's all free. Guys who want to take this to the next level know where to find me. But again, till my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?